Hello and welcome to Francis Financial's Investment Insights. Every month, our advisors break down the market trends to show you the impact that it has on the markets, your portfolios, and how they might influence our strategies to help protect and grow your wealth. And they come to your inbox every month. I'm excited to share part 2 of July, and I'll tell you in a minute. I'm Avni Ramnani, Managing Director at Francis Financial, and part 2 of July has been very heartening. Here is why. On your left, you'll see the different parts of the market segments, asset classes. These are all different terms that we use. The green bar that you see is the performance in each of these different segments of the market since the beginning of the year. So it's January through the end of July. And they're still pointing in the negative direction, as we've seen so much volatility in the market. Now, the exciting part is the blue bars. The blue bars are the performance for the month of July, and they are all pointing in the positive direction, which is heartening to see across the board, whether they're stocks or bonds, different parts of the market, all pointing in the positive direction for the month of July. What's even more heartening is that the gray bars, which is the longer term performance over the past 3 years in each of these segments, are still continuing to point towards the positive, which means that yes, some of the growth that we saw before has been eroded, but a lot of the growth still stands. So we're excited to see that. Now, what does this mean? This is an excellent example of why market timing doesn't work. Because if you had lost this month of July, being invested in the month of July, you've lost a pretty good return in your portfolio. And that's why we say that timing the market, when to buy and sell, timing the market is just not advisable. It just doesn't happen. It doesn't work every time. But time in the market, continuing to stay invested in the market is so much more important, is what you should do and is what we recommend. The other thing that we recommend is to stay fully invested at all times, having that diversification, having that exposure across all different asset classes is so much more important than concentrating risk, which is not advisable. So fully invested and through the market cycles, because that's when we see the growth coming in the portfolio. So what happened that the market performed the way it did? Well, the news is kind of similar. We are still seeing higher inflation. The CPI increased to 9.1%, another measure that the Federal Reserve likes to see. The core PCE was up almost 5% from June. So those are still going up. Now, the next Federal Reserve meeting is not until September. So there's a little bit of a breather. And while that's the case, we do still expect to see increased rates in September. Federal Reserve continuing that trend of increasing rates in September. Now, we don't want to guess exactly how much, because there is still enough activity in the market to warrant that increase. But how the Federal Reserve tries to engineer that soft landing, and we'll talk about that in a minute, is yet to be seen. Now, what is the news that's propelling this inflation, this growth, and this propensity to increase rates? It's the unemployment numbers are still down. They're at the lower end of the spectrum. We have seen a lot more jobs opening up, a tightening job market. There is some job loss claims that are rising, but they're not so much as to set out alarm bells. Now, the other thing that's slowed down is home sales. And we're seeing this as one of the direct impacts of increases in interest rates, which then increase mortgage rates. And that is causing a slowdown in the housing market. Now, inflation, we did expect it to continue at a higher rate, but the 9% was on the higher side of the expectations. Now, the signs are pointing towards a slowdown in economy, and the Federal Reserve is trying to engineer a soft landing because we could be in a technical recession. The definition of recession has a few criteria, a big criteria of which is 2 consecutive quarters of negative GDP growth. So if the economy grows negatively in 2 consecutive quarters, it's a big criteria that is met for technical recession. The Federal Reserve, on the other hand, is trying to control the impact and the consequences that arise from this recession. They're trying to engineer the interest rates in a way that this will not be a very devastating recession. It'll be a soft landing, which means the economy will land in recession, hopefully dust itself off, and then go back to its growth path again. That's what the Federal Reserve and all of us are really hoping for. So let's take a look at what some of the segments were that grew within the economy. The service sector did really well. We're seeing more restaurants coming back, people going on vacations, transportation is increasing. Some people are even commuting to work. So all these services around this segment are increasing. There are some sectors of the economy that are contracting, but that's in any given year that will happen. And the contraction is not so strong as to be worrisome. So those are the things that are happening. And this just gives the economists, people like us, the indication of how we might want to change, tweak your portfolios to see what might, if a change is needed, and what might that be. Now, what does it mean for portfolios? It means that we are taking a little bit of a look ahead and seeing that there is still some volatility coming up. We're still in a good news is bad news cycle, especially as far as the Federal Reserve goes. The economy, the jobless claims being down, low unemployment rate, increasing wage growth, increasing segments. This is all good news, but the Federal Reserve is viewing it in a way that the Federal Reserve is thinking all this growth shouldn't get overheated. They don't want it to get overheated because once it overheats, that's when inflation kicks in and we see high gas prices, food prices, transportation, all of that. So we're trying to see, looking ahead in August, there are some economic numbers being reported. We're seeing home sales. We think that's still continuing to slow down because of inflation and increase in mortgage rates. We're also keeping an eye on consumer sentiment. There are gas prices are trending lower and they are coming back down to in the $4 a gallon range. I've even seen a few that are lower than that. So that's good news. July performance has been pretty good and has reduced some of the losses that we had seen before. So if you were in a diversified portfolio, after July, it was down about 12%. So it was still down since the beginning of the year, but the losses have reduced. The other piece about wage growth and continuing consumer confidence is encouraging. So these are all the things that we're looking at as far as making changes to your portfolio, making any tweaks. Now, the final piece that I do want to talk about is the takeaways. So it has been a mixed, the economic news has been mixed. You know, there is some growth, there is some slowdowns, but for the most part, the economy is on solid ground. Companies are reporting their earnings, they're doing well. 87% of the S&P 500 is reported, and 75% of them have exceeded earnings estimates. So that's great news. You know, while GDP is down for 2 straight quarters, inflation is still high. So we're looking at how the Federal Reserve monitors that. The only thing, the big takeaway that we will say at the conclusion of it is that even though there is all this mixed data, there's a lot of noise going on. So we highly recommend putting on your noise canceling headphones, keeping down your head and just putting on that seatbelt and going through this volatility. Over time, this will settle down. Portfolios do come back and fundamentals win. So if your portfolio is designed in a way that looks at that long-term growth, it will come back. These losses will go away. Now, we are confident about that because we have always seen in the past that some of the best days that happen in portfolios are either during that bear market cycle or right after it, right when the bull market cycle picks up. So you don't want to miss any time invested in the market so as to not miss those good days. That's it for now. I'm Avni Rimnani. Please reach out if you have any questions. Reach out to your team, reach out to us if you have any questions about this at all. And we look forward to seeing you at the next month's Investment Insight.